Hi, everyone. Welcome to a KE Report webinar produced in conjunction with Focus Communications. I'm your host, Corey Fleck, also your host over at the KE Report website, where we follow the markets, economic news, and companies that we think are interesting and our listeners like to follow along with. In this webinar, I'm very excited to have on DevvStream and Focus Impact Acquisition Corp. We're going to be focusing on a business combination here between DevvStream and Focus Impact. I am joined by the CEO of Focus Impact, Carl Stanton, as well as the CEO of DevvStream, Trinh. Now, you all tuning in have the opportunity to ask questions during this webinar. I ask that you please use the chat function within this software or the Q&A function. I will be filtering through those questions and asking the questions throughout this presentation that the guys have put together, as well as a question and answer period at the end. If we don't get to all of your questions, you can always keep in touch with me through email, which I will share at the end of this webinar, to make sure that these guys do answer your questions in future interviews. Now, they have put together a presentation walking us through this business combination. I'm going to throw it over to you first, Carl. First and foremost, thank you for taking time to outline this business combination. And please give us a little background on Focus Impact Acquisition Corp.
Okay, I'll do that. Thank you. Excited to be here with you today, and thank you for taking the time to join us in this conversation. I'm just going to be working through some slides here. The normal disclaimers on forward-looking statements apply. This is the primary Focus Impact team. I serve as the CEO of Focus Impact. We are a private equity firm that was formed in 2020. We are a group of seasoned private equity investors that have had the good fortune to run or co-run a number of different well-known private equity firms. Focus Impact itself, it was our first vehicle in the special purpose acquisition market. It was created in 2021 with Citigroup and Goldman Sachs as our underwriter. We were over 4 times oversubscribed. And we were formed with the express purpose of finding companies that create top-tier financial returns while also creating some amount of social or environmental good. Our team includes over 15 professionals who come from various walks, including former C-suite executives, world-class investors, and large philanthropies. I myself have been a PE investor for over 30 years at firms including Wellspring Capital Management in New York City and Invesco. And my partners and I have over 100 years of combined private equity experience. We are really excited to be partnering with Sonny and his team. DevvStream met the primary qualifications that we had been looking for after searching through over 150 targets. We were excited to be introduced to Sonny and his team, and we believe very much in their mission.
All right. Well, thank you, Carl. Sonny, I guess let's get a quick overview of your team then over at DevvStream, and then we can dive right into this deal.
Okay. Thank you. And thank you for that too, Carl. As most of you are probably aware, DevvStream, we're a technology-based sustainability company created to advance the development and monetization of environmental assets such as carbon credits. We generate streams of revenue for other companies, organizations, and even cities and states through the use of carbon credits with a focus on technology. And we'll touch on that in more detail. But in other words, companies that have technology or are doing activities that helps reduce energy consumption or greenhouse gas emissions, we come in and provide a full turnkey service where we generate and monetize carbon credits for them in exchange for a portion of the credits. And as you can see here, our team's filled with seasoned experts in the ESG, sustainability, even carbon credit space. And then also our Chief Financial Officer, David Gertz, has experience in the public sector as well, too. So pretty complete team, and we have some of the leading experts in the environmental asset space as well, too.
All right. Thank you, Sonny. Now, Carl, let's get you to introduce this deal. But even before we get into the deal, if you could, for our Canadian audience, please provide a little background, an overview on what a SPAC company is, please.
Yeah, of course. So SPACs are special purpose acquisition vehicles. Basically, a new company gets formed as a shell with the sole purpose of merging with another company. Now, typically, SPACs merge with private companies, and that's an important distinction that I'll come back to in a bit. But in all cases, the idea is to introduce the target company to a larger, more liquid market, which in our case is Nasdaq. SPACs can provide several benefits for companies seeking to go public over traditional offerings. That includes speed to market, more certainty, and the ability to tell the company's story. In SPAC transactions, companies announce a merger transaction, which is what we did in September, and they tell their story to the investment community over the succeeding months, that while the company's finishing its documentation and filing with the SEC. We're in the middle of that process now. So this gives time for the company to introduce itself to investors, gives the investors time to do analysis on the company, to understand its unique business model, its projections, and to get to know the management team. All of this is meant to make for an easier understanding of valuation and for a smoother transaction. As you know, the IPO market in the US has been largely shut for the past 18 months. So SPACs are a very a popular way for companies to get public when the market is otherwise shut.
Okay. Thank you very much for that, Carl. I know a lot of our US listeners are probably up to speed on that, but that brings our Canadian listeners up to speed. Let's talk about the transaction then. Please start with these key highlights.
Yeah, sure. Well, maybe just to start with the beginning here. The transaction values DevvStream at $145 million US. Now, my quick calculation would have DevvStream's valuation at close yesterday just under $50 million US. So that's a substantial increase in value. Now, this is due to our review of the company's projections, the growth in projected revenue and EBITDA. In the backdrop of a larger, more liquid market, we believe that as the company spreads the word on its unique business model, and as investors see its contracts, its customer announcements, its projections, that these values will converge. Now, I should say just a word here about SPACs in the context of valuation, just to hit it off the top here. There's been a lot of bad press about SPACs and the valuations that have resulted from them. But despite the press, there have been over 90 SPACs that have successfully closed in the last 12 months. So it's a very active market. And when SPACs don't close, often the failure is attributed to just a few things. It's usually not having enough cash to close, either due to high redemptions, which are a feature of the SPAC investor, or their inability to raise what's referred to as a PIPE, the public private investment in public equity. So, and finally, the third one is regulatory hurdles. Now, DevvStream is unique in that it's already public. It already has withstood the scrutiny of Canadian regulators and has successfully filed its public offerings, maintained its on-time performance, and has gone through the wars that many private companies cannot withstand. So that's a major difference in this transaction. Another major difference is that for SPACs that don't close, the lack of PIPE capital or the high redemptions that I mentioned before, those are really just around, do you have enough cash to close? And oftentimes in deals that were written in the earlier part of this decade, they had high minimum closing cash conditions. And you can see that word spelled out often in merger documents. What that means is either side had the opportunity to not close if they didn't meet that minimum hurdle. Now the DevvStream transaction was structured without a minimum closing cash condition, specifically to address the risk of that. Now you'll hear later why. Sonny will explain why the company's business model is such that it just doesn't require a lot of the high capex that some of the failed de-SPACs suffered from before. So we think those are three major differences that really set this deal apart. Now, one more piece on valuation. So all companies, when they de-SPAC, come out at $10 a share. They're priced to go to $10 a share. And you can see it's often written in financial press that de-SPAC companies often decline and perform very poorly. Now, I've done a lot of research around this, and the way we believe it is more accurately portrayed is that there's effectively been a very, very large tech sell-off since the end of 2021. If you were to look at it on a graph, I'm sorry I don't have it for you here today, but if you were to look at it on a graph, you'd see, if you were to graph Nasdaq share prices, the index, and then you were to track companies that went public, so recent IPOs, and then separately de-SPAC companies, so three different lines. What you'd see is the Nasdaq had declined, but then picked up recently. You'd see IPO stocks are down materially, and right alongside IPO stocks are de-SPAC SPACs. So what does that tell us? The Nasdaq market is dominated by four major companies, as I'm sure your listeners know. Those companies have a disproportionately high market caps and disproportionately high valuations. That's been driving the Nasdaq. But IPO companies have suffered, and they're largely just growth equity companies. They've suffered, and that's what de-SPACs are. Almost all de-SPACs are high growth companies that are attempting to go public via a SPAC. They've just suffered along with all the other IPOs. So my point is that it's really easy to single out SPACs, but they just represent the decline in the overall growth equity markets.
Fair enough. You really have to judge them for the type of company that they're bringing onto the NASDAQ, right? And that's what this webinar is really all about. Why DevvStream type of thing. Yes,
for sure. There have been a number of home runs, DraftKings, Symbiotic, Vertiv. There are over 50 de-SPACs that are trading at over their offering price, despite that sell-off that I mentioned. Some of this is due to the sell-off of growth equities that I mentioned, and as of course it is often said and is true, there was just a glut of SPACs. The number of SPACs that were issued, in 2020 and 2021 alone, there were over 860 SPACs that were created in 2 years, and in the 10 years before that, there were only 220. So that gives you a sense of how much capital flowed into the SPAC market. And of course, there was some adverse selection in that. And, unfortunately, that number, which was over 60% of all IPOs during that period of time, was going to create some adverse selection. Those companies that were not public were not prepared to be public managers that didn't have sound business models or in DevvStream's case, contractual arrangements with their customers. Those types of companies suffered greatly, and you could say, deserved to have their decline in price. So just one more aspect I thought would be useful for your listeners.
No, Carl, I guess just to follow up on that real quickly, you are right. Look, SPACs were all over the news a couple of years ago, and there were a number of failures. Has that made it more difficult for you here running Focus Impact to get a deal done or to even find the valuation you're looking for?
Yes, we've had to change our thinking quite a bit over time. And it kind of leads us to why we were so interested in DevvStream. DevvStream represents, although it obviously is a young stage of its growth, it has features that make it very unique. Sonny's going to go through all this, and I don't want to steal his thunder, but you'll see that structure of the company's business, the way it's built its business model, it's highly profitable, it's got high growth, and it's got contractual relationships that give a degree of comfort to investors that doesn't usually exist in high growth businesses.
Okay. Yeah. Thank you. Do you want to take us through any more of this transaction then? Focused at all on this slide or even the next one, the investment highlights?
Just quickly, I'll point out a few things here that there are a number of assumptions made on this page, notably the amount of cash being raised from PIPE or cash and trust is placed at $53 million for purposes of this transaction. As I noted before, the company does not require that capital to grow, but that is our target in our raise. The valuation for existing DevvStream shareholders these are all in US dollars, I should say. The valuation for existing shareholders is the $145 million, and our assumption of the market cap once the transaction is complete is $250 million US. So you can see how we build up from 145 to 252 on the bottom left there. And if that happened, then you'd see that the incumbent DevvStream shareholders will own just under 60% of the total company. So that's how the assumptions were built. That's what the methodology behind it looks like. And none of the investors in my team will be sellers in this transaction, and the same for the insiders in DevvStream. Everyone is highly committed to the growth and sees the upside, wants to be a part of that growth process.
Okay. Thanks, Carl. One other question, I guess, when you talk about that money being raised through the PIPE there, it doesn't need to be that total amount that's outlined on this slide. The deal can get done for less than that, or is that a minimum amount?
No, that's what I was trying to allude to before, but it may have gotten muddy, that there is no minimum cash condition to close this transaction.
Okay. Is there a certain amount of cash that you want on the balance sheet for the company at the end of the transaction, though?
Yeah, and it's represented here. You can see that the idea that it's on the top right there, where it says cash to balance sheet of $40 million. That would be the ideal number that we would lead with. But I want to point out that we're at the beginning part of the regulatory process with the SEC. There are many months to go to get through that process, just like a traditional IPO. And I have no ability to predict what the stock market's going to do. I do know that based on our research on the company, it'll be announcing a number of positive transactions, contracts, relationships over the next several months, and we believe that will help turn into the valuation that you see here.
Okay, perfect. Thank you, Carl. Sorry, just a lot of questions came in on the back of that cash component, so
yeah, sure,
we can move on.
Well, maybe just really quickly here before Sunny. So I mentioned that at the end of the day, what's really happening here, it's easy to think of SPACs as an M&A transaction, but it's really not. It's the DevvStream is public. It's going to continue to be public. It's just going to a materially different market, and it's doing it simultaneously while announcing the next stage in its growth. And these reasons that are listed on this page are why we think the transaction is so interesting. The carbon market, many people are unaware of the growth in the carbon market. Sunny will walk through that as well, but it is a large and materially growing market. DevvStream's way of approaching carbon credit creation is unique, and we believe addresses some of the major issues in the carbon credit market today. And of course, the way it's gone to market is extremely results in extremely high margins. So you can see all of these issues that we list here that we think, bringing us back to the business itself and not the stock for a minute. This is why DevvStream is such a unique opportunity.
Okay. One final question, I guess, before we move on to Sunny, is that was Focus Impact actively looking for a carbon company?
we had a very clear mandate to look for companies that were either on the S or E part of the ESG spectrum, if we're allowed to use that word. We were focused on companies that were creating positive people outcomes, and so we weren't specifically looking for carbon credit companies. Indeed, there are very few opportunities for investors to find companies like this. Many of them are very small. Many of them are nonprofit. So DevvStream stands out in its professionalism and in its scale. Honestly, no, we weren't looking for one, but we were excited when we were introduced to Sunny late last year.
Okay, great. Thank you very much, Carl, for walking us through that. Please, everyone, keep sending in your questions. We'll take a little time at the end of this to answer more of those. But Sunny, let's get into more of the DevvStream business then. What can you tell us about DevvStream?
Yeah, so a couple of things. Actually, before we dive into this, one important piece of information that I'd like to add to what Carl said regarding the long-term commitment that both DevvStream and Focus Impact has on the stock. There's a lockup period of 1 year. So I want to make sure that everyone understands that. So when Carl says that, it's not only do we want to stay in the long term, but we're contractually obligated to stick within it for 1 year as well too. So there's a lockup period. And then one other thing I'd like to add too is just why is this transaction important to DevvStream and why we chose Focus Impact as well? Because it takes two to tango, right, Carl? So it goes both ways. But well, like any high growth emerging company, right? We were looking for access to capital to really fuel our growth, since we have way more projects than we can handle. And we'll touch on that in a little bit as well. And at the same time, we have a great opportunity to take advantage of our leadership position to capture significant market share. So moving to Nasdaq would allow us to do this much faster, because being on Nasdaq gives us access to a much larger capital pool, like Carl said, including and especially funds that have requirements around investing into sustainability companies like DevvStream. And it also increased our liquidity. So as a result, we looked at various options, including SPACs. And we didn't specifically target SPACs at the beginning, but we also wanted to consider it. So we ended up speaking in probably about 4 different SPACs, and one really stood out, and that was Focus Impact. The first reason was what Carl said, was that their goals and missions to find a company that is creating a positive impact on the world on the E or the S portion of it, really perfectly matched with our goals as well. And then really, we got to know the leadership team led by Carl, and we just clicked. I always tell Carl, it's like love at first sight, right, Carl? We worked well together. Everything just clicked, and then we just moved forward. And now we're very close to filing our S4, and if all goes well, we should be the first and only carbon company on Nasdaq within a few months. So I want to make sure everyone kind of understands that portion of it as well too.
Perfect. Thank you. So that actually addressed a couple of questions that just came in. So yes.
Okay, good. And so as far as some highlights about DevvStream, first of all, the opportunity. I think a lot of people don't realize this, but the carbon credit market is massive. In 2023, expected to be $1.16 trillion, growing to $2.68 trillion by 2028. So not only is it massive, it's still growing. And where it gets really interesting is we have a very disruptive advantage with our focus on technology. Majority of credits today are focused around nature-based, but there's been studies done that in order for us to meet our net zero goals by 2050, nature-based solutions will only address up to 20% of the emissions reductions necessary. So the other 80% needs to come from technology. And that's where we focus on it, and that's where we're one of the very few companies that focus on it, and we feel we are the leader in there as well too. Another area that's real interesting, and again, we'll touch on it in a little bit more detail, is we have a business model that's very low capex, where we provide a service to these technology companies. We come in and we find these companies that are eligible for generating carbon credits. Majority of them don't know how to do it because it is a very complicated process. So we go do it for them in exchange for a portion of the credits. So there's no capital expenditures on our part upfront, other than the cost to generate, validate, verify, and register the credits. In addition, we play in both the voluntary and compliance space. So for those that are familiar with carbon credits, there's 2 main types of carbon credits aside from nature and technology. The other differentiation is whether they're a voluntary credit or whether they're a compliant credit within various government jurisdictions. A good portion of our credits will be compliance credits, making them much more sellable, but also the value is much higher as well. Again, we'll touch on that in a little bit, but to give you an idea, voluntary credits can range anywhere from a few dollars to most of them like 25, 30. There are some higher ones where in the regulatory compliance space, for example, in British Columbia, there's what's called the LCFS program or low carbon fuel standard. Those credits right now are going for about 450 Canadian dollars. So a big significant difference. And then lastly, I think Carl touched on it a little bit as well too. We're already a public company. So uplisting makes sense to the reasons I just explained earlier, but also the likelihood of this transaction going through is much higher just because we've already gone through a lot of the filing requirements. We mainly need to convert it to US GAAP. And so everything seems to be much smoother as well too.
Okay.
Right. So moving forward, I mentioned before that DevvStream it provides a service for these technology companies to generate carbon credits for them. So we provide a full turnkey service. We do literally everything from taking their data all the way through to registering it, selecting methodology, selecting the proper registry, whether it's voluntary or compliance, and then also monetizing it and finding buyers. We have a contract rate with a large global energy company to buy up to 650,000 carbon credits, compliance credits in Canada. So there was an announcement of that about a month ago or so. So, we literally do the entire process, which really no one else or very few other people are able to do. And then we do it in a way where there's little risk for our technology partners because they're not putting any money up front either. So we're bringing streams of revenue to help advance our technology further. And we're able to do it in a way that provides a very high quality set of credits, which increases the value and also certainly for the buyers that they're not greenwashing. So.
Okay.
And then one more thing I'll touch on is our revenue model. I mentioned before that we have a very low capital requirement model where we come in and we manage the entire process, full turnkey for the customer in exchange for typically 25% of the credits. It's great for both sides because these technology partners, they get a new stream of revenue that they don't expect in the first place that helps drive their technology further. And for us, we get a stream of revenue without putting very much money up front. So the IRRs are quite high in this case. We do have a second business model where there are some projects that require some CapEx, and we will make some investment in those, like oil well plugging, for example. In this case, we look for projects that gives us a 2-year payback period, and the streams typically last about 10 years or longer. So it's still a strong IRR, not as good as the carbon management model, but it gives us some flexibility as well too. And that's what we're moving into this SPAC route and raising capital allows us the flexibility to choose either one. But we expect probably about 90% of our business to be the second model where we're managing these projects for our technology partners. And one more thing I'll add is that we have a pretty broad network. And that's also one of the reasons why we really enjoy working with Focus Impact. Their network is massive as well too. So we have already a large network. They expand us even further. But what we do is with our networks, we're able to take these technologies into other locations to help them grow their business, which generates more carbon credits for us and for them, and allows us to enhance the technology further, and at the same time create more of an impact throughout the world for carbon mitigation.
Okay, so just to reiterate there, it's more the management aspect that you are focused on, this revenue model B, rather than actively investing upfront initially in these projects.
Yes, that's correct.
Okay. Would that change at all with more cash on the balance sheet through this SPAC transaction? Would you invest a little bit more on the front end of projects to retain more of the carbon credits?
I wouldn't say so. And the reasons why we need the capital as well for the second model is we have a program approach where we're able to aggregate multiple activities throughout a region, maybe entire country. So we need additional resources and people to help run those programs. So, for example, we have a building sufficiency program that we announced and are getting ready to launch. We're getting ready to assign cities at a time. There's a lot of buildings there, which means there's a lot of people to help that's necessary in order to manage the entire program and bring on additional partners, whether it's hotel chains or universities and college campuses or municipal buildings as well too. So we expect to do more of the D side, the project management. But as we scale and grow, we have the ability to scale at a tremendous amount. We need people and resources to eventually manage all those relationships.
Okay. So I guess keep an eye out for some sort of deal, some sort of partnerships with either governments, large residential, large business firms. Those are the type of companies you're looking at that could really move the needle on a revenue front.
Yeah, no, absolutely. I mean, well, think about it. The beauty of technology, one of the advantages is that it's extremely scalable, right? So when we talk about buildings efficiency program, well, how many buildings are there in North America, right? And our model is very low entry, low cost, because anyone who wants to join, they don't have to put any money up front. So we're offering them a way where they just send us their data and we manage the whole process for them. And then we give them streams of revenue based on the energy savings or the carbon reduction that their buildings provide.
Okay. Thank you, Thank you, Sunny.
I think we can probably skip this. It just kind of reiterates that we provide a full turnkey service all the way from taking the data from our technology partner and then doing the validation, verification, and so forth. So it makes it very easy and very simple for them.
Sunny, who are some of these technology partners then? Can you give us more information on them?
Yeah. So, for example, we have an MOU signed with a Japanese company, a $2 billion Japanese distributor of electronic products called Ryoden. They distribute high efficiency HVAC systems, refrigeration systems, even EV chargers. So we met with them, and they're selling to these end customers like governments and so forth. That by doing this, they're eligible for generating carbon credits, but they didn't know that. So we would come in and act as their carbon credit managing entity to, again, provide the full turnkey service. So for every EV charger they sell, we help them generate carbon credits. Or think of, hotel chains would be another client. It's where we, through our billings program, they would come in, and again, we're talking to several hotel chains as well too. But many of them are going through upgrades. Maybe again, they upgrade their HVAC systems or their lighting systems, or even provide renewable energy, maybe solar panels within hotels. We take all that and we help them generate credits to help offset some of the costs of these upgrades.
Okay, thank you. I hope that addressed that. One question that came in. Let's talk about this pipeline of opportunities.
Yeah, like I mentioned before, right? Part of the raise is to bring on more people and more resources because we have way more projects than we can handle. We have over 140 opportunities that's identified in our pipeline. But roughly about 25 of them are actively pursuing, and we have roughly 7 contracts with another 5 out right now waiting to be signed. And all these either involves bringing on new technologies or participating into our current programs. And we have 5 programs that we'll be launching. That includes buildings efficiency, which I mentioned. We have one for industrial efficiencies for factories. We have oil well plugging, LED lighting, and then we also touch on a little bit on the nature-based side as well, too, bringing technology into forest conservation and preservation projects.
Sunny, how quickly can these move up, or I guess down the food chain here into active projects then?
Really, a lot of technology companies that we were talking to, their products and their technologies are already in place. They're already utilizing it. And so it's a matter of finding the right methodologies. And if we have our program that's already in existence, we can literally do this in weeks. But if we need to create and register, again, depending on the registry, it can take 3 to 6 months, maybe a little longer, depending on the registry.
Okay, so kind of a wide time frame there.
Yeah.
Is there news on the front end of any of these deals that investors can look forward to, or are you just going to be press releasing when you have a project that is now considered active and generating carbon credits?
Yeah, so we've announced several already over the past 4 or 5 months. I mentioned the agreement with Ryoden. We have a partner called Prosper that does wastewater treatment at up to 83% energy savings. We have a contract with them. And then we have an EV charger company that we're in the final stages of our contractual agreements as well, too, along with several other technologies. So there's quite a few that, like I mentioned, the contracts we have outstanding right now that we're waiting to complete. Once deals get signed, we'll be providing announcements as well. So expect to hear that in the very near future. And that's what Carl alluded to as well too, on why Focus Impact selected DevvStream, because of this pipeline and these contracts that we have going and soon to be going.
Okay, thank you. We can move on then.
Yep. Jump past this, and I'll pass it on to Carl.
Yeah, maybe just a little bit here.
Oh, sorry.
This is what we distilled the business model down to: diversified sources of revenue, recurring revenue streams, contractual, repeatable growth model, and then the high margins that Sunny mentioned, and then in the current project set, low capex. Those all spell a success story for growth companies in our mind, and graphically you see that the projected revenue between now and 2025 takes the company up to $55 million. Now, it's important to note that DevvStream is a relatively young company. It just went public in earlier in this year, and Sunny and his team have been at this for a materially longer period of time. But the biggest focus had been to build the contract base, to build the technology, to build the IP moat that they enjoy today, and that they're able to offer to their customers. So it would probably follow the same growth curve as many other successful growth companies. So the difference being that the way the company's modeled out its projections here is driven by a relatively small number of contractual relationships that that, as Sunny referred to, as we worked our way down that pipeline. The company's got extraordinary margins because it effectively in this point in its life cycle it's more akin to a consultative model, where the knowledge base to create carbon credits, the ability to work those processes all the way through to registries and to sale is effectively trade secret. It's not easy to do that. It's time consuming, and it requires a lot of intellectual horsepower. And DevvStream is lucky enough to have all those boxes checked. So as a result, the company gets paid in carbon credits for its services, and this represents the high margin. This is why there's so much high margin. There's the cost of goods sold, if you will, here is de minimis. One thing that we were very focused on was what happens if a certain type of industry goes out of favor or is for some reason unable to develop credits, and we started to focus a lot about diversification. The company's diversified well over different project types. It's diversified over geographies, and it's diversified by credit type as well. But when we start to look at how do you value this, what do you compare it to? Obviously, it's not easy. There's not many companies that operate in the same space, and none of them operate the way DevvStream does. So we looked at it this way. We looked at it as a combination of yield and streaming companies and renewable companies. DevvStream had features of each, and none the same of any of them. That's what makes it unique, and we think makes it extremely interesting right now as a trendsetter coming onto Nasdaq. If you compared it to those companies, you'd see that the growth that Sunny and team have projected is materially higher than these companies are projected to produce. And when you look at the capex required to produce that revenue, it puts DevvStream up in the top left corner. So very unusual positioning. Similarly, if you look at its profitability, because of the business model I mentioned before, you can see that the margin and the capex profile puts it back again in the top left corner. So, these are our estimates of how our positioning of the business to the larger investor base. Of course, this is our estimate of how to do it and how the company should be valued. And this is what we're working on now to convince investors that we're correct in that.
This is really critical, right, Carl? Because that's how you are valuing DevvStream. A lot of people are asking how you came to that 145 million US amount to value DevvStream here. It's through these future projections, is it not?
It is. It's a commonly used in the SPAC technology, where because the companies are merging and not an IPO. In a traditional IPO, you're not allowed to discuss projections, but in SPACs you must, because it's a merger of two companies, in this case two public companies, and in doing so the board has to consider and disclose what it considered when approving the merger. Projections are always a critical key part of that. So it's really a byproduct of that process that allows us to show the projected revenue here. It's been done many times in the SPAC world, and for successful companies. So it's not unusual to do that. DevvStream's case, it's critical because it allows the company to tell its story and to play out this work they've been doing for the past couple of years in numerical format.
Okay, thank you for taking that one. Another question then, more sunny for you, I guess, is what's the model for monetizing carbon credits? Once you generate them, people are wondering how you're going to get the cash in, how you're even pricing out the carbon credits.
No, that's a great question, and we get asked that quite a bit. So there's two main models, right? So the first one, which majority of our credits we expect to monetize, is through direct corporate relationships, where any company, organization, and actually even countries now that have net zero goals will need to buy carbon credits, because they can only take their operations down so much. But as long as they have buildings, as long as they have transportation, they're going to have emissions. So they can't get it down all the way to zero without buying carbon credits. So we're in contact with quite a few of those as well too. And right now, one of the biggest concerns from these organizations is a term called greenwashing, where they're buying carbon credits that aren't truly creating an impact, especially some of the nature-based ones. And so that's why the credits we're generating with technology is much more precise. Because when you look at a building's efficiency program, for example, I can tell you exactly how much energy a building was using before they put in a new HVAC system and how much it is afterwards. And hence, you can calculate the exact impact and the amount of carbon credits that should be generated. So there's almost no chance for greenwashing in that case. Well, so to answer your questions, we're working with a lot of these private companies and also talking to countries as well too. And for example, I alluded earlier, but we made an announcement that there's a large global energy company that placed an order to buy a minimum of 250,000 credits with an option of another 400,000 credits over the next 3 years. These are compliance credits in Canada. And so that's an agreement that they found us, and we're really interested in what we're doing, because they mentioned that they can't find enough high quality credits for what they need. So we have that in place already without even going out and really searching for a buyer. We're starting to do that now. Then we made an announcement. Once we made that announcement, other buyers came in. We received emails the same day saying, hey, we're interested in those credits as well. So that's the first area. And then if there's credits that for some reason, if we can't sell them, there are exchanges out there. We have very close ties to Expansive, the largest voluntary exchange in the world. Their former chairman was on our board as well, and now as an advisor for us. So we have really close ties. So we have two different ways to monetize the credits.
Now, when do you think some of these revenue numbers will start materializing? Because we saw some pretty aggressive growth projections here. What should we be looking out for in terms of revenue when it starts materially coming in the door?
Yeah, so it's really dependent on when the credits are issued. And again, I mentioned it's a very lengthy process, and that's why we created a program to reduce the timeline. But we expect that to happen next year. We expect credits to start coming in Q1 of 2024. And like I mentioned, we have a contractual agreement already for an offtake or an offtake agreement. So once we start meeting that agreement, we bring in revenue immediately. So as soon as we generate credits, we already have a buyer.
Okay. Carl, let's bring you back in here. Can we talk about the steps that are left in terms of major milestones to complete this transaction?
Sure. The merger agreement is publicly filed, so it's available for everyone to look at. That the next steps technically are the filing of a merger proxy with the SEC, which would allow the SEC to review the offering materials for completeness before we send them out for the final vote to shareholders. So we expect to have the proxy ready for file in the next couple of weeks. We expect that I can't really opine on how long the SEC will take to review. They have a statutory period when they come back for comments, and then we go through a comment process. And we really don't. There is widely available data about how long that should take to get through. Our anticipation is that the transaction closes in the first and maybe second quarter of next year when we're through with all of that. So during that process, the company will be performing on its business model, announcing its new agreements, and then we'll be actively meeting with investors to help fund individual projects and to fund the de-SPAC transaction itself. So from right now, it's basically now in the company's hands to perform, and we're actively engaged with the company to help however we can as investors, and we're actively talking to customers in our universe, offtake agreement partners in our universe as we speak.
Okay. Now people are just kind of wondering how this valuation comes to market too, simply because of, well, some of the recent trading in DevvStream, but that all is kind of market dependent when the deal closes. So that's hard for us to address right now. But Sonny, there is a question here when it comes to generating voluntary credits, compliance credits, and both. You said that some of these projects can generate both of these credits. People are wondering, is that double counting though?
No, so actually, well, when we're generating credits, it's either compliance or voluntary. It's not both. When I say we do both, it means that we have projects that generate voluntary and we have projects that generate compliance credits. So we have a combination of both. A lot of it depends on jurisdiction as well too. So for example, our Billings energy efficiency program that we're rolling out in the U.S., that would be a voluntary credit. But in certain parts of Canada, like in Alberta, for example, that would fall under the Alberta tier compliance programs. So those Billings efficiency program in Canada, in Alberta, would be worth more than it would be doing in the U.S. But again, because we have such a low CapEx model, it's still very lucrative both ways for us and for our partners.
Okay. People are wondering how this transaction works if, say, they buy DevvStream right now on the public markets and the SPAC then goes through. How does the valuation transfer over? How do the shares transfer over? Can either of you take that, please?
Yeah, the company will once they merge, there'll be one stock. It'll still be DevvStream stock with a new ticker, a Nasdaq ticker. The numbers that I was referring to on the prior page of valuation are our contracted values. What does that mean? It means that you're unlike a cash merger. This is a stock for stock merger. So the value at the closing will be dependent upon how the market sees what we've laid out for you today. Now, I've explained why we think formerly the NEO market is a small marketplace where DevvStream wasn't getting a lot of attention. DevvStream has virtually no analyst coverage, and there's nobody else, and it's got a very, very small float. So the company wasn't getting attention, and rightfully so. So part of this transaction is to open it up to a different marketplace. The other part, and more important, is to lay out the business model that Sonny just said, to talk about how that business model leads to these results and to these valuations. So what you have to you have to go through that logic path and come to the conclusion that the valuations that we have are correct. If the market agrees, I think it could be low, we could be high. This is the valuation benchmarks that we've used. So it's important that everyone understand that this is not a cash transaction. This is a stock transaction, but it has some of the elements of stock transactions that you really want. There's no cash leaving the table for investors. The investors are all locked up and aligned on seeing the long-term success of the business. And our entire job is to help the world get to know DevvStream, both customers, offtake partners, and investors, to understand why it's such a unique and important company.
Okay.
Yeah, if I can add to that to Corey, just to add more clarity. So as far as the valuation, today, like Carl mentioned, the company is valued a little bit under 50 million US. So the data that you have on like Yahoo and so forth, Yahoo Finance, the market cap is not accurate, just because we have some multi-voter shares that made it a little complicated. So once the transaction goes through, the valuation that the DevvStream current shareholders will be at is at 145 million US. So essentially what that says is, if the stock stays at that price, like Carl mentioned, that the rough estimate would be $2.03 Canadian, again, depending on the exchange rates. But that would be the value of the stock at the close of the transaction.
Okay. Guys, thank you very much for this. Look, we are running out of time here, so I'm going to leave two major questions on the docket for you both here. Thank you, everybody, first of all, for sending in all these questions. I have all of them saved, and I will be bringing both of these gentlemen back on my show to address more of these questions. But let's talk about risks first. Any major risks to this deal not getting done?
Well, I want to point everybody to the merger agreement, because they're well laid out there. But I'll just speak generally, if I may. Because the company and our company have agreed to no minimum cash condition, then the biggest question is, does the company get through the regulatory approval with the SEC? That would probably be the biggest single question. And what I would point to there is that over 90 companies in the past 12 months have successfully gotten through that process. There may be many that did not, that I'm unaware of, but that is a well considered process. The company and Focus Impact both have very intelligent and experienced counsel specifically related to these matters. I guess you'd have to say that there are closing conditions that would fit any transaction, a major movement in the markets in general, but there are very few outs in the transaction, so again, I'll just point your viewers back to the documents that are filed.
Okay.
Yeah, and then I'll if I can add one more thing too. I think the fact that we're already a public company also increases the likelihood as well too, because we're not going from private, where, like Carl mentioned before, the company doesn't know how to act as a public company or do the proper filings and so forth. We've already done that. So moving from from Canada to US, it's a shorter path, I guess, the best way of putting it.
Okay, that makes sense. Now, look, easy question at the end here. Major benefits of this deal getting done. We've just spent about 45 minutes talking about this deal. Summarize it all for everybody, please, and the key stepping stones that, again, they can look out for.
So on the DevvStream side, I think the biggest thing is we get access to a larger capital pool, especially, like I mentioned before, institutional investors looking to invest into sustainability ESG companies like DevvStream, access to more shareholders, higher liquidity, and then also access to more deals as well too. The US is a much bigger market, and there's a very high interest in sustainability companies like ours. So I think that's very positive.
Okay.
We think also that if you think about what's really happening here, not maybe putting the stock aside for a minute and talking about what the company's doing, countries, large corporations, small corporations have made commitments to reduce their carbon footprint. And that is done in the context of global warming, which is generally received as something that we can, as global citizens, that we can impact. DevvStream is not the first entrant in the carbon credit market. There's $1 trillion of carbon credits traded on national exchanges in Europe and in California and in Canada, and there'll be many more coming. Those are regulatory credits. Voluntary credits are small. It's a couple $1 billion market that's anticipated to grow 25-fold in the not too distant future. And what is all this around? This is all trying to remove carbon or eliminate carbon from being produced in the first place. What DevvStream has done is it's allowed, with its business model, it's allowed technology credits, which address one of the major issues that existed before they came into being. And it's allowed companies to either reduce their costs or for developers to make money off of it. We believe that having a capitalistic model tied to a global good is a positive thing. It will encourage people to bring down their carbon footprint and allow them to do it economically. So we think this is one of the, it'd be a great outcome if there were other people that built onto DevvStream's model, and DevvStream would be, very, very happy to have competitors. It's a very, very big market that's growing. So in that, in order to meet that goal, you have to hold yourself to a very, very high standard. Investors want to make sure, buyers of carbon credits want to make sure that the company is doing things to the highest degree of credibility possible, and that's really what's driving our merger. By making the statement that we are the first company that's going to be publicly traded in the U.S. That's going to hold ourselves to these standards is meant to be a symbol that you can trust the credits that come out of DevvStream, and you can trust DevvStream as a corporate partner.
Okay. Well, Carl, Sonny, thank you very much for taking time. Everyone, thanks for sending in those questions. As I mentioned, I have them all saved, and I will be conducting a couple interviews with these guys as this deal continues to move forward and get those questions addressed. So please keep emailing me all your questions. Carl, thank you very much for your time. Sonny, as always, thank you for your time. And everybody, thank you for tuning into this webinar. We hope you all found it valuable and informative.
Thank you all.
Thank you all. And thank you, Corey.